Hi, I'm Scott Wentworth, the founder and head writer at Wentworth Financial Communications. I recently had the opportunity to moderate a panel about sustainable and responsible investing and some of the challenges that it creates from a marketing perspective for asset managers. The event was hosted by the Financial Communications Society here in Chicago. And one of the panelists was John Hale, who is Morningstar's head of sustainable investing research. John talked about the genesis of Morningstar's sustainability index and some of the challenges that financial advisors still face in talking to clients about sustainable and responsible investing. Here are some of the highlights of what John had to say.
Well, I'm the global head of sustainable investing research at Morningstar. I've been doing that for about 3 years. It's a new position that we just created 3 years ago. I've been at Morningstar serving in a number of different capacities for the last 20 years and had always been interested in this field and had had at different times investment management clients who were focused on it as well. And I actually worked for a couple of years with an asset manager that focused on SRI, the traditional terminology that you used in your introduction. Circa 2015. I mean, one of the things Morningstar does is the mission of the company is really to provide investment research and tools and information that investors of all types can use to make better decisions. So company mission's been the same thing for 35 years. So here we are in about 2015, and some of these things that have already been mentioned starting kind of exploding onto the scene, really. If you're looking at the number of assets invested in ESG, sustainable investing, whatever it's called, the number of asset managers that are doing, what Blake said is happening at William Blair. I mean, the numbers were exploding, and I had one a CIO of he was an asset owner, which he ran a $20 billion pension plan. He said, I'm in the process right now of transitioning my portfolio to managers that are going to be focused on ESG. Some of them are doing it in an outcome-oriented fashion. Others are just integrating ESG. We're requiring it. $20 billion portfolio. And it's like, how's that going? And first of all, I thought, wow, this is even more evidence of how big this field is getting, but how's it going? And he said, well, the interesting thing is there's a lot of uptake on it. I mean, the managers want our money. They want to be able to manage our money, so they're embracing it, in terms of what they say they're doing. But the trouble is, I don't really have anything to judge any basis for judging what they're doing exactly. Like, if it's a value manager, Morningstar's given us the style box. So, at that point, this sort of light bulb went off in my head and it was one of those new LED light bulbs, right? That's very sustainable. So there's no heat or anything, but it kind of went off in my head that so there's all this information out there that's being provided primarily to asset managers on how sustainable companies are. It's called ESG. We call it ESG ratings or ESG data, but it's primarily for asset managers' use. And we thought, well, what if we simply brought this data in-house and started being able to evaluate portfolios just like this manager suggested we do? And so I wrote this. I came back and wrote up this proposal, not really necessarily thinking it was going to go anywhere, but or not going anywhere very fast. But I wrote up the proposal, the Morningstar sustainability rating, and just within a month we were working on it full time, and by the end of the year we had it out. So we had a sustainability rating for mutual funds that is not perfect. Right, Colin? It's essentially, it takes underlying company information and tries to say, well, if you're looking at a portfolio overall, how well are the companies that are held by that portfolio? How well are they doing on a variety of ESG issues that are pertinent to their business? And So that's kind of how this all got started at Morningstar, and from there we've just recently put out a new set of carbon risk metrics that evaluate how much carbon risk a company or a fund has based on the underlying companies in the portfolio, and we have a number of other initiatives, including one with, I'm talking about some of the biggest challenges. One is that advisors in the U.S., we have a lot of advisors that's one of our major constituencies and major set of clients and customers are financial advisors. And one of the things we're seeing is that survey after survey showing everyday investors highly interested in this concept of being able to invest this way. But when they go to financial advisors, a lot of financial advisors are like, "What? You don't want to be doing that," or it's you're gonna give up performance, and they try to, and that's been that's kind of what's happened in the past. Well, you've got a ton of female investors, in particular, millennial investors, huge high levels of interest in this kind of investing, but the financial advisor that's the 58-year-old man who's practiced it for 20 years does not want to necessarily get up to speed on it. So we've partnered with Money Management Institute on an advisor education program that hopefully will, at least for those that are interested in getting up to speed on it, will be able to take that course and at least get up to some level of speed on the issue so that they can address client interest in the field.